Let's jump to the next part of this clip.
The second thing is that once you do start building it nationally, and again, don't know your policy, but it's not going to be substantially different. The average rate of return on the $95, if you look at your actual cash value buildup, including the 3 years of zeros on the front end, it ends up being an average of about 1.2%. Let's be generous and say it's double that, 2.4%. Still not a good long-term investment. If I could get 2.4 on my money market, I'd be dancing a jig, but not on my long-term investments. My long-term investments need to be north of 10% to be beating inflation and taxes. And so it's a horrible rate of return on a long-term investment.
Okay, so Dave brings up now his second major problem about whole life insurance. He says, quote, "It gives us a horrible rate of return on a long-term investment," end quote. Now, just about every single word in that sentence is completely wrong, maybe except the phrase long-term. That might be the only part I agree with. So many of his claims about rate of return are also just factually false. First, what can I agree with him on? First, I agree that whole life insurance is not, I repeat, it's not an investment. It's life insurance. It's a life insurance policy with a savings component known as cash value. In fact, people who refer to whole life insurance as an investment can lose their license. Oh, but wait, I realize Dave Ramsey does not have a financial license, except a radio license. Maybe that's the only authority he has, is to speak on the radio. No financial advisor need apply to his job. That said, if all I cared about was the cash value, I still would be pretty impressed with the whole life insurance over a long term, there's that phrase again, as a saving strategy to build up tax-favored liquid cash and to let it continue to grow for me even when I access money for any reason. Dave is claiming that whole life insurance gives you a mere 1.2% rate of return, and then he says, hey, let's just be generous and double it to 2.4%. And then he sort of wishes that his money market account could give him 2.4%. He's opining that he's got such low rates of return in his money market accounts. Well, I have in front of me right now a case study. Again, I'll add this link to our show notes. This case study was of someone who bought a old, boring, dusty whole life policy that Dave Ramsey loves to hate. He bought this policy back in 1963. The policy was built mostly for cash accumulation, the way we like to do it at Lake Growth Financial Services, although not with a company I'd prefer to use these days. Now, the article stops the clock after 50 years. So we go from June of 1963 to June of 2013. And the premiums Mr. Smith, in this case study, Mr. Smith paid in over 50 years was a grand total of $26,100. Okay, so the money Mr. Smith had put into this thing over 50 years was a total of $26,100. And the cash value had grown to $138,489, a little over 138 grand. Guys, do you realize that represents a non-taxable gain of $112,000 over 50 years, which is a 5.57% internal rate of return every year from inception? Wow.